Title: Navigating the Financial Seas, Unveiling the Distinct Worlds of Stocks and Bonds. In the intricate tapestry of the financial markets, two prominent players take center stage: stocks and bonds. These instruments, though fundamentally interconnected in the realm of investments, represent distinct avenues for investors seeking to capitalize on their financial ventures. Understanding the nuanced differences between stocks and bonds is crucial for anyone looking to traverse the unpredictable seas of the financial world. Stocks: the shareholder's gamble. Stocks, often referred to as equities or shares, embody ownership in a company. When an investor purchases shares of a company's stock, they essentially become a partial owner of that business. The ownership stake grants them certain rights, such as voting on corporate decisions at shareholder meetings and participating in the company's profits through dividends. The value of stocks is inherently tied to the performance and outlook of the issuing company. As the company flourishes, so too does the value of its stock. Conversely, if the company faces challenges or downturns, the stock price may plummet, exposing investors to potential losses. One of the defining characteristics of stocks is their volatility. The stock market is subject to various external factors such as economic conditions, geopolitical events, and industry trends, all of which can influence stock prices. To illustrate, imagine a technology company launching an innovative product that captures the market's imagination. The demand for its product skyrockets, propelling the company's stock price to new heights. Conversely, a manufacturing company facing increased production costs due to global supply chain disruptions may witness a decline in its stock value. Bonds: the creditor's haven. On the flip side, bonds represent a form of debt issued by governments, municipalities, or corporations. When an investor purchases a bond, they essentially become a creditor, lending money to the issuing entity. In return, the issuer promises to pay back the principal amount at a specified future date, along with periodic interest payments. Bonds are often considered a more conservative investment compared to stocks. The fixed interest payments and the return of the principal at maturity provide investors with a predictable income stream and a level of security that is absent in the more volatile stock market. To delve deeper, envision a scenario where an investor purchases a government bond with a 5% annual interest rate and a maturity of 10 years. Throughout the aforesaid period, the investor receives consistent interest payments, and at the end of the 10-year term, the initial investment is returned. Risk and return dynamics. The fundamental contrast between stocks and bonds lies in their risk and return dynamics. Stocks, with their potential for significant price fluctuations, offer investors the allure of high returns. However, this comes hand in hand with heightened volatility and the possibility of substantial losses. In contrast, bonds, with their fixed interest payments and return of principal, offer a more stable investment environment. Nonetheless, the trade-off is a potentially lower return compared to the dynamic world of stocks. To further elaborate, consider an investor with a higher risk tolerance and a longer investment horizon. Such an investor might allocate a larger portion of their portfolio to stocks, banking on the potential for long-term capital appreciation. On the contrary, an investor nearing retirement or seeking a more conservative approach might favor bonds to safeguard their capital and generate a steady income stream. Diversification: the investor's safety net. Astute investors often employ a strategy known as diversification to mitigate risks associated with either stocks or bonds. Diversification involves spreading investments across different asset classes, sectors, and geographic regions. This strategic approach aims to create a balanced portfolio that can weather the storms of market volatility. Imagine an investor who allocates their funds to both stocks and bonds. In a scenario where the stock market experiences a downturn, the potential losses incurred on the stock side of the portfolio may be offset by the stability and income generated from the bond investments. This synergy between different asset classes is a key principle in risk management and wealth preservation. Market conditions and economic indicators. Understanding market conditions and economic indicators is crucial for investors looking to make informed decisions about allocating their funds between stocks and bonds. Economic indicators such as inflation rates, interest rates, and unemployment figures can significantly impact the performance of both asset classes. For instance, in a period of low interest rates, bonds may become less attractive as the fixed interest payments may not keep pace with inflation. Conversely, stocks may thrive in an environment of low interest rates as companies can borrow money at favorable terms, leading to increased investment and potential stock appreciation. Asterisk the role of time horizon and investor goals. Investors' time horizons and financial goals play a pivotal role in determining the suitable balance between stocks and bonds in their portfolios. A young investor with a longer time horizon before retirement may be more inclined to take on higher levels of risk and allocate a larger portion of their portfolio to stocks. This is because they have the luxury of time to ride out market fluctuations and benefit from the compounding effect on their investments. Conversely, an investor approaching retirement or with a short-term financial goal may prioritize capital preservation and a steady income stream, making bonds a more attractive option. The need for liquidity and stability in the face of imminent financial goals guides the decision-making process regarding the allocation between stocks and bonds. Conclusion: navigating the waters with prudence. In conclusion, the distinction between stocks and bonds is not just about financial instruments. It's about crafting a financial strategy that aligns with one's risk tolerance, investment horizon, and financial objectives. Stocks, with their ownership allure and potential for substantial gains, cater to those seeking growth and willing to weather market volatility. On the other hand, bonds, with their fixed income and relative stability, provide a haven for those prioritizing capital preservation and a predictable income stream. Successful investors recognize the importance of a diversified portfolio, intelligently blending stocks and bonds to achieve a balanced and resilient investment strategy. As the financial markets continue to ebb and flow, the astute investor, armed with an understanding of the nuanced differences between stocks and bonds, can navigate the waters with prudence and set sail towards financial success.